Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Five9 Inc. And let me tell you, it's got more twists and turns than your average customer service call, maybe even one that ends with a surprise extension. So, what's this all about? In short, Five9, a company that provides cloud contact center software, is letting us know about an important decision regarding their executive severance plan. This plan dictates what happens if certain high-ranking employees are terminated, especially if there's a change in control of the company. Think of it as an insurance policy for top executives. The company's stock is traded under the symbol FVIN. This report is not about written communications related to a business deal. This report is not about soliciting material that is like asking people for votes on a decision. This report is not about the start of a tender offer, which is when a company offers to buy a bunch of its own stock. This report is not about the start of an issue a tender offer, which is when a company that is already public offers to buy more of its own stock. Now let's get into the details. Specifically, we're looking at item 5.02, which covers what happens when directors or certain officers leave, get elected, are appointed, or receive certain compensation packages. In this case, it's about something called the 2019 Key Employee Severance Benefit Plan, or KESP for short. It's a plan that outlines what happens to certain executives if they leave the company under specific circumstances. This Key Employee Severance Benefit Plan was originally put in place in April of 2019 and was set to expire in April of 2025. But hold on, because here's the interesting part: the company decided to extend it. On February 11th, 2025, the Compensation Committee, which is responsible for deciding how much executives get paid, decided to give the KSP a 2-year extension. This means the plan will now continue to protect those senior executives for a longer period of time. The good news is that the level of benefits has not changed for the participating senior executives. The extension provides the same level of protection as before. So what does this plan actually do? Well, if Five9 terminates an executive's employment without cause, meaning there's no good reason like poor performance or misconduct, and it's not related to a change in control, meaning the company isn't being bought or sold, the executive gets a severance package. This severance includes a lump sum cash payment equal to several months of their current base salary. The amount depends on their tier within the plan and also covers the premiums for their continued post-termination healthcare coverage or continued coverage under the company's health insurance plans for a certain amount of months. Again, depending on their tier. The highest level of coverage is 12 months. Now, here's where it gets even more interesting. If the executive's employment is terminated without cause, or if they leave because of a constructive termination, meaning the company makes their work life so unbearable they're forced to quit, and this happens close to a change in control, either a few months before, right when it happens, or within a year after, the severance package gets even sweeter. In this case, the executive gets a larger lump sum cash payment. The months of salary and target bonus are greater than with just a normal termination. The level of healthcare coverage is also extended. Most importantly, they get full acceleration of their unvested equity awards. This means that all of their stock options and restricted stock units that haven't yet become fully owned by them immediately become theirs. This can be a very valuable benefit. There's also a catch. If the payments and benefits under this plan would trigger a special tax called an excise tax designed to penalize excessive compensation, then the payments and benefits will be reduced if that reduction would actually result in a better after-tax outcome for the executive. In other words, they won't get paid so much that they end up paying most of it back in taxes. To get these benefits, each executive has to sign a release of claims, meaning they promise not to sue the company, and they also have to keep following any agreements they've made about not competing with Five9 or stealing their customers. The document also lists who is in each tier. The Chief Executive Officer is in Tier 1, the Chief Financial Officer is in Tier 2, and the Chief Operating Officer and Executive Vice President of Product Engineering are in Tier 3. These determine how many months of benefits and coverage they receive in case they are terminated. In conclusion, item 9.01 lists the exhibits. The actual extended and amended severance plan is included as an exhibit to this report and is available for full reading. This document and current report are also formatted using inline XBRL. This is a special coding language that helps computers easily read and analyze the data. Now, what does all this mean for Five9? Let's break it down. Assessing the company's direction, Five9 is essentially ensuring stability at the top. Extending the severance plan can be seen as a way to retain key executives, especially when the company is facing potential changes or uncertainty in the market. It's like saying, we value you and we want you to stick around. However, it also raises a couple of questions. Why the extension now? Is Five9 anticipating a potential acquisition or some other significant event that could trigger these severance packages? Or is this simply a routine measure to keep executives happy and motivated? Risks and opportunities. One potential risk is the cost of these severance packages if multiple executives were to leave around the same time, especially if there's a change in control. These payouts could be substantial and impact the company's financial performance. On the other hand, a strong and stable leadership team is a huge asset, particularly in the competitive cloud software market. This plan could help Five9 attract and retain top talent, which is essential for driving innovation and growth. Stock price outlook. Valuing a company like Five9 isn't easy. It's a growth company, so traditional metrics like price to earnings ratios might not be the best indicators. Instead, we should be looking at things like revenue growth, customer acquisition, and market share. The stock is currently trading around $60, $70 a share. Based on their growth prospects and the overall market conditions, a reasonable target price range would be $70, $85 over the next 18 months. Conclusion. Overall, I'm leaning slightly bullish on Five9. The extension of the severance plan suggests a commitment to leadership stability, and the company is well positioned to benefit from the growing demand for cloud contact center solutions. However, investors should keep a close eye on the company's financial performance and any potential changes in the competitive landscape. Thanks for watching. If you found this analysis helpful, please subscribe to Corporate Decoder for more insights into the world of corporate filings. Don't forget to like and comment below.